Hi, and welcome to the Early Retirement Roadmap Podcast, the show where I help you achieve and thrive in early retirement. What would it take to live on $10K a month, every month, for the rest of your life? And not just scraping by, but thriving, feeling comfortable, and being able to travel and feel free from financial worry. In this episode, I'll talk about how much you need for a $10K per month retirement and what could make that savings number drop by hundreds of thousands of dollars. But I'll also show you why that magic number is more complicated and more flexible than you might think. Let's walk through how to figure out your $10K per month number and why 3 key factors could make or break this goal. Plus, I'll share some risks and strategies you might not have considered, especially if you're aiming for early retirement. Let's start with a simple benchmark. If you want to spend $10K per month after taxes, you might need to withdraw around $12K before taxes, depending on your account types and tax situation. So that's $144K per year. Now, traditionally, people use the 4% rule to estimate how much they'll need. That means you'd need about $3.6 million saved to safely withdraw $144K per year over a 30-year retirement. But here's the thing about the 4% rule. It should be used only as a starting point to get a quick ballpark figure because it assumes you have no other income, no Social Security, no pensions, nothing. And it assumes a 30-year retirement. But if you're retiring early, your retirement can certainly be longer than 30 years. And among other issues with it, it doesn't account for large one-time expenses like helping to pay for your children's weddings, and it's based on historical market returns which may not repeat. In fact, recent research from Morningstar suggests the 4% rule might be too optimistic for today's retirees. In their 2024 State of Retirement Income Report, Morningstar recommends a starting safe withdrawal rate of 3.7% for new retirees, reflecting lower expected returns for both stocks and bonds compared to the past. And with lower expected returns in stocks and bonds, many experts recommend going even further than Morningstar and suggest starting with a 3 to 3.5% withdrawal rate, especially if you retire early or want extra safety. That means if your goal is to spend $10K per month after taxes, you might need closer to $4 to $4.5 million to be truly confident, depending on your risk tolerance and how long you expect your retirement to last. But don't panic over this large number. There are ways to bring that number significantly down. In fact, there are 3 big levers you can pull that can drastically reduce how much you actually need. The first lever is there's income that's not from your portfolio. Things like Social Security, pensions, annuities, and rental income all reduce what your portfolio has to cover. For example, let's say as a high-earning married couple, you expect to receive a combined $5,000 per month from Social Security. That's $60K per year. This reflects 2 strong earnings records and claiming at full retirement age of 67. If your retirement spending target is $12K per month before taxes or $144,000 per year, your portfolio only needs to cover the difference. $144K annual need minus $60,000 from Social Security leaves $84,000 per year that must come from your investments. Using Morningstar's recommended 3.7% withdrawal rate, your target portfolio drops from about $3.9 million to generate $144K per year to about $2.3 million to generate $84K per year. That's a whopping difference of $1.6 million less you need to save. If you want to be even more conservative and use a 3.5% withdrawal rate, you'd need about $4.1 million for $144K per year, or about $2.4 million for $84K per year. Again, that's a substantial difference. 1.7 million less, in fact, and shows how powerful Social Security can be in reducing your portfolio needs. The second lever you can pull is the account type and tax strategy. Pulling 144K from a Roth IRA to fund retirement is not the same as pulling it from a traditional IRA or a taxable account. This is because for Roth IRA withdrawals, qualified withdrawals are tax-free, so you keep every dollar, but only if you're age 59 and a half or older and your Roth has been open at least 5 years. If you're younger than 59 and a half, you can always withdraw your contributions tax and penalty free, but withdrawing earnings may trigger taxes and a 10% penalty unless you meet certain exceptions, like a first-time home purchase or disability. Traditional IRA and 401k withdrawals are taxed as ordinary income, so you'd need to withdraw more to net $10K per month to cover the taxes. And then there's pulling from taxable brokerage accounts to fund retirement, and they have their own rules. Capital gains, dividends, and taxless harvesting can help manage your tax bill and control if you need to pull $12K a month or not to fund a $10K per month in spending retirement. So smart tax planning and the accounts you pull from can shrink your magic number by thousands of dollars. The third lever you can pull is your retirement timeline and withdrawal rate. If you retire early, say in your 50s, your money may need to last 35 or even 40 years. That means you should use a lower withdrawal rate, closer to 3%, to reduce the risk of running out. If you retire at 65 or 70, your time horizon is shorter, so you can usually withdraw a higher percentage each year. For example, a 20-year retirement might allow a 5% withdrawal rate, dropping your required portfolio to about $2.9 million if you need 144K per year or $12K per month before taxes and have no other income. Just remember, the longer your retirement, the more conservative you should be with withdrawals. Now that we've done all the math, it's important to realize that it's not just all about the math, because there are two big risks every retiree, especially early retirees, need to plan for. The first is sequence of returns risk. If you hit a bad market right after you retire, your portfolio could take a big hit early on. This sequence of returns risk can cause even a well-planned withdrawal strategy to fail, especially if you're withdrawing a fixed amount each year. So how do you mitigate this? First, keep 1 to 2 years of spending in cash, like a high-yield savings account or short-term bonds. This is a widely recommended cushion to help you avoid selling investments during a downturn. Some experts like Charles Schwab suggest holding up to 4 years in a combination of cash and conservative bonds, since the average bear market and recovery can take about 3 to 4 years. Your exact number should reflect your risk tolerance, withdrawal needs, and comfort level. Second, you could consider a bond tent strategy as you approach retirement. If you're not familiar with this term, a bond tent is a time-based shift in your asset allocation. You gradually increase the share of bonds in your portfolio during the years leading up to retirement, peaking at or just after your retirement date, and then slowly decrease your bond allocation as you move further into retirement. The idea is to create a tent shape in your asset allocation chart, rising before retirement, peaking, then tapering off. Why do this? The bond tent helps protect your portfolio from big market downturns during the most vulnerable years, right before and after you retire, when losses can be hardest to recover from. By holding more bonds during this period, you reduce your exposure to volatility and the risk of having to sell stocks at a loss to fund your spending. After the first few years of retirement, you slowly decrease your bond allocation, but you still keep a healthy mix of bonds and stocks for safety and growth. Most people don't shift back to a very aggressive stock allocation. Instead, they settle into a balanced mix like 60% stocks and 40% bonds, or whatever fits their comfort level and goals. The second big risk is inflation and healthcare costs. Inflation can erode your purchasing power, especially over a 30 to 40-year retirement. Healthcare is another wild card. If you retire before Medicare at 65, you may need to budget $1,000 to $2,000 per month just for health insurance and out-of-pocket costs. Don't underestimate or forget about these expenses in your 10K per month in spending target. The good news is that your Social Security benefits are not static and are adjusted for each year for inflation through cost of living adjustments or COLAs. So that helps with the inflation risk. But in reality, those adjustments have often lagged behind the actual inflation retirees experience, especially for healthcare and housing. So keep that in mind. In conclusion, it's easy to get overwhelmed by giant retirement targets. But the truth is, to fund a 10K per month spending in retirement, your number is probably lower than you think, if you plan smart and stay flexible. The key takeaways to remember are this. Other income sources reduce your need. Social Security, a pension, rental income, annuity payments, even considering part-time work. And don't overlook home equity too. For many retirees, their home is a significant asset. Downsizing, selling, or relocating to a less expensive area can unlock home equity and reduce the amount you need to save in your portfolio. Each of these can offset how much you need to withdraw from your portfolio, lowering your overall magic number needed for 10K per month spending in retirement. Then there's the account types and tax strategies that affect taxes and healthcare subsidies before Medicare kicks in. Your time horizon and withdrawal rate also change what your magic number is. And finally, sequence of returns risk and inflation are real, and you must plan for them. And as we talked about, the 4% rule can be a useful starting point to give you a very rough ballpark for your retirement number. But remember, it has limitations. It assumes no other income sources, is based on historical market returns, and doesn't account for taxes, one-time large expenses, healthcare costs before Medicare, or changes in your spending needs. For this planning to get to your magic number, use tools like Bolden.com, a retirement modeling tool that I like and I personally use and works great. It lets you plug in your numbers and test different withdrawal scenarios. Also, a fee-only financial advisor can help you build a plan tailored to you and help you work through all of this. Well, that's all for this podcast. If you found this information helpful, please like, subscribe, follow, and leave a review. Also, when you're not on the go, check out my Early Retirement Roadmap YouTube channel and go to mikeupland.com for all my media, including my blog. Until next time, this is Mike Upland, early retiree, last year at age 55. Take care and make the most of today.